Hello, YouTube. It is a new month. We're going into March of 2023, and the S&P on the first day put in a new low. So we're going to talk about whether or not this is a sucker's rally, and we're going to circle back and look at Peter Lynch's indicator. So please stay tuned all the way till the end of the video if you want to see exactly what those are. Let's have a look here, an update on what we talked about yesterday, or the one-for-one risk reward. After we initially lose 409, but from where we are right now, there's about 15 points lower to get down to about 380. And about 15 points higher to reclaim about 410. Why does that matter? It matters because I said that if we print a new low, even just a marginal low, I think it's going to self-manifest or just self-fulfill, meaning that we're probably going to go lower. Why does this matter? Well, let's just look back to what we looked at yesterday. Let's also delete everything and just get a nice fresh view here. Why? Because I like simple stories, and hopefully you do too. I think simple is what we want. And simple makes it very easy to follow the narrative. All right, 2 daily candle closes below the 50. All right, that's not good. Nope, it's not good. And yesterday I actually made an error. I said elevator up and staircase down. The stocks usually take the staircase up, which means they go up incrementally, higher, 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 and then they take the elevator down. So they go up a little bit and then down fast. Well, just as an update, we have going back to February 15th, we have 1, 2, it doesn't even matter. It's every single one. It's either all red, like we talked about, or we got full green candles, which just means that we've closed lower. So there has not been a single day since the middle of February where we have done two things. First thing being close green. Second thing being close higher than we opened. That has not happened. So it's a slow fade. And as long as that continues, we have to be very mindful of this area because we actually came down to test pretty close to our 200 DMA, and we also rejected on our 50 DMA, which means that we're finding sellers where we would expect them to. We're also finding buyers where we would expect them to, pretty close to the 50 and pretty close to the 200. So who's going to do it? Are we going to get knocked up and invalidate the head and shoulders, or are the bears going to knock us down and take us lower? It's like really important. So let's go through a couple of news articles, then we'll come back and have a look at these because these monthly charts are actually giving us some different signals. QQQ is not quite at a monthly lower low yet. But when we look to the dollar, we look to the VIX, we look to treasuries, they're giving us a few mixed signals. So please make sure to stay tuned and we'll go through this. So the markets are coming to terms with a higher for longer Fed. What does that mean? It means that Fed swaps price and hikes policy rate of 5.5 in September of 2023. All right, Justin, tell me what that means because I have no idea. Don't worry, I will cover you. Let's have a look here. So what it means is that yields are going up. And as a reminder, there's an inverse relationship between treasuries or bonds and what stocks do. So when these lines point up, here we're looking at the 2-year note. It breached, how high did it get to? 4.9 today. We got a monthly higher high, and it's looking pretty bullish. We look at the 10-year note, and it breached for not quite holding it, but it is also over the previous monthly highs. What does this mean? It means both of these charts pointing up means that stocks should be going down. Here's where it gets a little bit complicated. We talked about this pricing it in, but the dollar is actually down. So the dollar down, yields up, we got gold up, Bitcoin up, we got emerging markets up, and we got China up. Man, it's like confusing out there. Yeah, it's only the first day of the month too. Let's go through and see if there's anything else to give us some context. Also important to note that we still haven't actually fallen down into neutral. So I believe, again, not I know, but I believe that is the reason why we're seeing this slow fade down here because the bulls are just not really feeling like there's been pressure added on yet. There was only really one day where we actually had a sizable move lower. Otherwise, it's been a drip, 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 right? Drip, 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 dead cat bounce, drip, 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 dead cat bounce, drip, drip, drip. And we usually get a drop at some point. So not sure if we're going to get a repeat of this last red day, which was the 21st of February. But this drip, drip, drip gets really frustrating until a certain point where the pain threshold gets met. And we can see that here by volume increasing. It's not like huge, but red days with bigger volume just means that people are generally looking to sell more. It means there is starting to be an exodus out. So until we actually fall down into neutral and back into fear, I think there is still a chance for the bulls to save us. We just can't really afford to stall out very much longer. All right, so now let's go through this Peter Lynch warning, and then we'll have a look here at the rest of the charts and leave you with a little bit of hope at the end. All right, so warning of a stock market bubble. Warnings of a stock market bubble finally proved too much for the S&P 500. Stocks look stretched relative to future growth, which is a PEG ratio. What's the PEG ratio? The PEG ratio is the price to earnings growth ratio. So it's the PE divided by annual EPS. So make it really simple for me. It is a valuation metric for determining the relative trade-off between the price of a stock and the earnings generated per share and the company's expected growth. So it basically talks about the future. All right, let's just read a little bit here because I think they actually did a good job of typing this up. Wagering on the stock market bounce was always a long shot. Now it looks like a sucker's bet. Make sure to drop me a comment. Tell me what you think. And if you guys wouldn't mind, I'll ask only once today. If you wouldn't mind destroying that thumbs up and consider subscribing to the channel, I would greatly appreciate it. Thank you so much ahead of time. While the reemergence of a hotter than forecasted inflation was the proximate cause of the latest plunge, another force is also at play in the second largest blah 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 blah. Let's have a look here. Richly priced blah blah blah. The model, a tool from Fidelity's legendary Peter Lynch a generation ago, is the PEG ratio. The market's price to earnings multiple divided by the forecast growth rate, which we just looked at. The higher it is, the more expensive shares are. And right now, it's at about 1.8. That's the chart we just looked at here. It's starting to get expensive like it was in 2020. It's also not a perfect indicator. So again, just take this with a grain of salt. I just wanted you to click on the video. So there you go. I got you to click. Thank you. Stretched multiples at a time of stiffening Federal Reserve resolve to whip inflation now is a cocktail for investors have wanted no part of in February, as we just showed you on the chart. Over a holiday shortened week, that concluded with an unexpected acceleration in the central bank's preferred inflation gauge, or PCE. The S&P slid 2.7. So this is like a look back to before. Valuations do seem stretched on most earning multiples, but when you insert the level of growth and the fact the growth is slowing, they look even more stretched. So there you go. We're not going to read too much more beyond that. And the second reason why there's a little bit of a concern today is because we actually saw GDP revisions get revised lower. That's the first time this month, from 2.8 on Friday to 2.2 today. So why does this matter, Justin? Well, it matters because we've only seen revisions higher ever since January. So it started at about 0.67, went to 1, went to 2, went to 2.5, went to 2.7, went to 2.8, and now it's back down here to 2.2. So remember, it's only March 1st, right? So we're 2/3 of the way through the first quarter. And this number is, again, it's a moving target. So we're not sure exactly where it's going to settle. But trust me, people watch this closely. I know I do. So what this means is that maybe there's some growth concerns, or maybe there's a risk we're going to do too much. That's what the bond market's saying by going higher. It thinks, yeah, the Fed's going to have to do more. Right? Just keep squeezing over the 50 and just can't stop. We look here to the 10-year note, pretty much the same thing. Over the 50, tested once, tested twice, and then advanced. Even got over the previous high and cleared it. We look to the dollar, though. This is why I think the dollar's down. Also, in regards to what is happening over in Europe, we note here that the dollar actually has a bearish engulfing one-day candle, which I believe is related to that GDP number. Here's where it gets funky, though. So if gold is up, right? Gold's up today. Okay, Bitcoin is up. Ether is up. Oil is up. Why are stocks not up? I don't know. Right? They got drilled into the close yesterday. They got drilled today. So like my spidey senses are tingling a little bit here. It's hard for me to explain. When I look across here too, here's what's really weird. Dow was up. New York Stock Exchange up. That's 2,000 stocks. We look at the Russell or IWM, it's up. We look at SMH or semiconductors up. Energy up. Here's where some money flowed today. Emerging markets. So there was some money flowing into emerging markets. The ETF is up by 2% today. And then China had some blowout numbers and it's up by 4%. It's having a pretty big run. So this just looks like people are rotating out of stocks into things that are arguably safer here. You get a risk-free return of 4.8% on the 2-year note, 4% on the 10-year note, and stocks are just not really risk-free right now. I think there's a lot of skepticism, for myself included. All right, so now let's just look at a few more quick charts to make it really simple. Let's look back at our monthly chart. We're going to look at S&P and QQQ. We're going to look at Apple and Microsoft, and then we're going to look at daily charts because a lot of charts actually tested their 200 DMA today. That's the 200 daily moving average. So S&P, we already talked about how we opened at 395.41. We're closing at 394.7. It's pretty close to where it opened. Let's look at the NASDAQ, though. So the NASDAQ is actually holding a higher low. Higher low, which means that it actually saved the previous candle low. I think, again, I think that if this actually prints, that is going to be the nail in the coffin for the bulls because the NASDAQ already has a pretty bearish pattern. It's a massive head and shoulders here. We're not sure if we're going to actually get that lower area yet. We just have to watch it really closely. So please just don't ignore it. I went over that yesterday and also on the weekend. So now let's have a look at Apple and Microsoft and see how they're doing. Okay. So not a failed breakout last month, but now we are below the monthly high we were looking at. But as of right now, it is still an inside bar. So what would Apple have to do to confirm the bearish move? It would have to fall below 141. So then that would form some kind of head and shoulders here on the monthly, but that's only really confirmed if we get bearish price action. So I would say we got to blow out 141. Looking to Microsoft, had a failed breakout yesterday, and exactly what I just mentioned on Apple is is it already happened? No, not quite. So if QQQ is going to hold on to its monthly low, I think Microsoft has to hold on here. 24547, so 47 cents. Here we got 79 cents. That's not very much of a save. And this candle's already pretty big. It's almost as big as the real body going back to January, and it's already basically 2 times the size of the February real body. So let's make sure we pay attention to that really closely. All right, take us home. We got a couple more quick charts to look at. Let's have a look here at S&P, because I know we mostly look at S&P, but just note, I just look at S&P because it's a $300 stock, and most retail traders don't want to look at SPX or the E-mini futures. So that's why we focus on SPY. It's not because it's the only thing out there. Why does this matter? Well, because we didn't actually get a test of our 200 DMA. Remember that the gray line corresponds to the gray number over here, which is 393.14, and we hit a low today of 393.38. So what does that mean? It means that this is an ETF, right? It's an exchange traded fund. So remember, it's trying to replicate what SPX does. SPX is the index. It does not provide a dividend. So why does this matter? Well, because we got a true test of the 200 DMA here. This is what smart money looks at, not retail, but smart money. But it's worth 10 times more. So most retail traders are like, man, I can't afford that. They don't understand how the market works. So we got a true test here and a bounce, but we did not actually test the 50 DMA. That's really notable. Then we look here to the E-mini futures. All right, E-mini futures, what happened? Well, again, same thing as SPX. Did not quite hit our 50, but we did breach our 200. That's significant. All right, last one here, QQQ, or the Qs. This one here, not quite. Let's just look here really close. Not quite to the 200 DMA, but awfully close. It's off by about 11 cents. It's not a lot. Let's look here to NDX now, which is the NASDAQ 100. The low here is 11,906, 11,903. So off by $3 on a $12,000 stock. Whoa. Now let's look at NQ. All right, NQ breached. So remember, if you're looking at S&P and QQQ, just remember that these are ETFs, and they're trying to recreate what the index does. So please just keep that in mind. And if you wouldn't mind dropping me a comment to tell me what you think, I would really appreciate it. If not, the video from the weekend should already be queued up, which told you how we thought we would get here and might provide some insight in terms of what actually shook out this week. If not, thank you so much for tuning in. I look forward to seeing you tomorrow.